Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
You are listening to the financialsurvivalnetwork.com. I'm Kerry Lutz on 1230 WBZT. Well, interesting times. Gold prices appear to have bottomed along with silver. And where's it going to now? Well, that's the question. Got to look at supply and demand. Got to look at those charts, something that I've seldom been able to wrap my arms around. That's why we've got Nick Barisheff, author of recently released book, Gold 10,000. Nick, welcome back to the Financial Survival Network.
Thanks for having me. My pleasure, Gary.
Hey, so your personal feeling, you think the metals have bottomed, huh?
Yeah, it looks that way. It looks like the bottom was about 1190 for gold and 1860 for silver. And right now we're about 17% above that for gold, even with today's pullback, and 26% above that for silver.
Yeah, they were, Mickey Fulp, the mercenary geologist, and I, we do a monthly market review of every major market in the world, minus a few. And for the past 2 months, the metals have been where the action was at, because they just got so beat down that a buying panic ensued. And really, when you got to the point where the gold to silver ratio was 66, he thought it might go up to 75. I just couldn't see it sustaining 66 to 1.
Right.
So, and what do you think's ahead now?
Well, I think now that we've got this part over, there's like the continuing balance between supply and demand. First of all, you've got mine production was flat. Now with this correction, it's actually going to be declining because mines are closing. And then in South Africa, you got major strike action. Some have settled, but that's also going to affect supply dramatically in both gold and platinum, as well as some of the other strategic metals. So you've got that kind of disruption to supply. On the demand side, the demand is all seemingly in the east. Like when you've got 400 tons leaving the ETFs, you got 400 tons in the last quarter being bought in bars, in the east. And when you look at Shanghai deliveries, this is deliveries, it was like 1,400 tons of deliveries versus 1,700 tons of mine supply. So that's getting up there, and that's how an exchange should actually operate. Versus the COMEX, which is all, straight paper with practically no deliveries. And in the central banks, that's a big disparity, because between 2003 and 2008, the central banks were selling about 500 tons a year. That was the limit under the Washington Agreement. But in the last few years, they've been buying 500 tons a year. So that's a 1,000-ton differential in a market where mine supplies 2,700 tons. Not insignificant. And we actually don't know what China's buying, because they don't publish what their sovereign wealth fund is buying. And last time the sovereign wealth fund was quietly acquiring and then transferred 600 tons to the central bank. I think we can expect an announcement probably sometime in 2014 that the central banks added several thousand tons. And when that announcement comes, there'll be another big surge in the gold price.
Right. And no one should be surprised by this. I don't know if you've had a chance to catch this TV series called Gold Rush.
Yeah, I've seen a few of the episodes, yeah.
Yeah, well, they've given up on the Klondike, and now they're in South America. And they're getting bitten by snakes and mosquitoes and tarantulas and black widow spiders. They don't care because they're just out there going for the gold. And obviously a lot of it's staged, but not all of it's staged here, Nick. And it's just incredible to watch the extent that human beings will go to get gold. That's my only point in bringing it up. It's just remarkable.
Also, if you go back to the 70s, there's a lot of mines producing like 20 grams per ton. Today, you're lucky if you get 2 or 3 grams per ton. So that's a lot of dirt to sift through for 2 or 3 grams.
Yeah, well, now these guys find themselves in the middle of Guyana in a jungle. Mm-hmm. And they're strictly placer miners. They don't want to be blasting mountains and, cutting through tunnels. Although they visited a mine in, where was it? Peru. It's the highest city in the world, 17,000 feet up there, and it's like the Wild West. They've got boxes of dynamite. OSHA would close this mine within 15 minutes. It would be boarded up, and they'd be sent home. But there's 50,000 guys living 17,000 feet above sea level, and these guys are like, one of them is morbidly obese. He's ready to pass out any second. It's a miracle the guy doesn't have a heart attack. And they drive in like pickup trucks into the guts of this mine, Nick. It's the most amazing thing watching it. And, they're about ready to blast another hole in the mine, and they're like racing to get the heck out of there. It's just held up by timber, basically. And, they're wheeling and dealing, trying to stake a claim here and there, and then outlaws come and say, gringos, you better get out of here if you know it's good, or we're going to kill you. And, like I say, even if it's staged, it's not all staged. It was pretty amazing to watch these guys in search of gold.
My hat's off to those guys. It's a tough life to dig up the gold. A lot harder than just printing the money the way Bernanke does, right?
Yeah, I mean, all of a sudden, Nick, that printing press is looking pretty darn good, I'll tell you. So there's got to be an easier way, but the point is, that I can see that there's going to be some type of event, and somehow we're all going to rediscover the virtues of gold and being on a gold-backed currency and having a gold-backed economy. There really is no other way that we can get ourselves out of this mess that we're in.
Well, it's like 4,000 years of history. There hasn't been a single example in all of history that a fiat currency doesn't end in hyperinflation and then complete collapse. All of them have always ended this way. The difference this time is that you've got a global fiat currency in terms of the US dollar as the reserve currency, and you're going to have a global hyperinflation.
Yeah, and you're seeing it right now. The most amazing thing is that every currency in the world is inflating right now, except to some extent the US dollar. You see that inflation being exported. The rupee, the Brazilian real, I think it is, the Turkish lira, they're all inflating right now before your very eyes. And
just the U.S. has just concocted the methodology in terms of the CPI that grossly understates inflation, but we're really running around 8-9%.
It's just and we get to play the games, but all you have to do is measure it by a Thanksgiving meal. To me, that's the truest rate of an inflation measure, because every year you buy the same junk for Thanksgiving. I guess you guys do in Canada as well. Exactly. It's the same turkey. It's the same yucky canned cranberry stuff, although some people make it from scratch. The same stuffing. the same bottles of wine, and it goes up 13% every year. They measure it, same stuff. So you can only fool people so much.
Right.
But it's happening all over the place. All those currencies are going to blow up. The only other difference, Nick, that I would mention here is that the world is also on this oil standard because we got to have this oil to sustain our life. And the relationship between oil and gold really isn't one that's explored very much, but it's been consistent from the 30s, even the late 1800s, early 1900s, oil to gold ratio, that I think it's 35 or something like that.
From 71
14, yeah.
through, once gold was released, it's been around 15,
Right.
between 15 and 20 to 1. And that's the one thing that's been a relatively stable relationship. Everything else, has essentially deflated in gold terms. Like, whether it's houses, cars, they've inflated in currency terms and deflated in gold terms.
Yeah, and that is something that you really need to understand, that you can have deflation and inflation at the same time and not be aware of it and not understand the ramifications of it, which are really quite grave when you're not aware that it's happening. Peter Schiff talks about this all the time. He's ignored, belittled by the mainstream financial press, that he doesn't know what he's talking about and that it doesn't make any difference. And we're going to talk more about that up next with Nick Barisheff, author of the book Gold 10,000. Important read. You really need to get it on Amazon. I'm Kerry Lutz on the financialsurvivalnetwork.com, 1230 WBZT. So you know that I start out most of my days at a certain coffee shop that will go nameless. And now I take my coffee in a thermos. You need to try this amazing new roaster out of LA, Tonks Coffee. These guys are fanatical about delivering the best beans in the world. They source directly from growers, roast it, and ship it within 24 hours, so it's as fresh as it can possibly be. Every 2 weeks, you get a new batch of incredible beans roasted to perfection. If you're hitting a cafe most mornings, like me, this is much, much better, and it's cheaper too. It's the best way to get great coffee. Tonks is by subscription only, and they'll give you a free sample just for listening to the Financial Survival Network. Go to tonks.org/liberty and get some for yourself, or send it to somebody you know who appreciates finer coffee. Tonks.org/liberty, and send me an email. Let me know how you like it. I promise it's the best coffee you've ever tasted. And we're back on the financialsurvivalnetwork.com. Kerry Lutz. We're with Nick Barisheff, author of Gold 10,000, a must-read. You really need to get it. And we're on 1230 WBZT. Nick, just expand a little bit more about how it's possible to have deflation and inflation at the same time, and that really these highfalutin economists out there are oblivious to this fact because they're using the wrong measuring sticks, if you will.
Well, that's right. And this is where, first of all, typically, when you look at assets, they're not part of the inflation deflation discussion, in that when real estate increases, we call that appreciation. We don't call it inflation. Same as the stock market. So you need to take that off to the side. The real issue is what the components of the basket are from a cost of living point of view. And that's where they made the changes going back to 1989. And John Williams of Shadow Stats has a great detailed explanation on his site what the changes were. But essentially, it used to measure the rising rate of a fixed standard of living. And then that was changed to measuring the cost of living. That's a very subtle change, but very important, because with having a fixed standard of living, you had the same elements measured every year. And that gave you the true inflation. Once you switched it to cost of living, there was all kinds of adjusting entries, hedonics, etc. And like a simple explanation would be that if in the original basket of goods there was a steak as a component, and the price of steak got too high and people ended up switching to hamburger
or chicken or
yeah,
fish.
or chicken. So then, they would say there is no inflation, but you're not eating steak anymore. And it's just a ludicrous way to look at it, because what comes next? Dog food and then starvation and still no inflation, probably. That's the way they look at it. The other thing is that they put real estate in as like 40% of the CPI component, but the way they calculate real estate, it isn't the cost of owning a house or cost of renting a house. They take the book value of all the houses and apply an imputed rent amount. And only when that house sells do they increase the imputed rent amount. So it's a very slow moving average. Like, you could have bought your house 20 years ago for like 1/5 of the price. And that's what's used in the imputed rent amount. So it's a ludicrous way that was purposely meant to understate inflation. And if you go back to the original measurement, which John Williams does on his site, you get around 8 or 9% today. Now the thing is, inflation is also different for everybody. If you're making $1 million a year, then the percentage of the million that you spend on food, clothing, and gasoline is a small fraction than someone who's in the low income scale. That's all of their income. So it makes a huge difference, on an individual basis, and that's where the problem lies right now. The average wages of the middle class have actually been going down, and the cost of living has been going up.
Yeah, and therefore, and they've been going down since effectively mid 1970s.
That's right.
Real wages have been in a tailspin, and the middle class has been squeezed. So they made up the difference by borrowing in large measure. But as we saw in 2008, eventually the piper gets paid, and you can't borrow anymore. You can't use your living room as the ATM. You can't hock the kitchen, and the borrowing comes to an end. And then not only is your standard of living not even the same, it goes way, way down real fast. And that's what we had then.
That's right. And that's typical of, all the other examples of fiat currencies throughout history. They can't end any other way. But this, and it's very subtle and it's long term, and most people don't notice it until it gets to be very acute and where you've got hyperinflation. And the kind of numbers are really mind-boggling. People think $10,000 an ounce gold is a stretch, but that's nowhere. I'm not suggesting that's a top by any means. I'm just saying probably going to get there in plus or minus 5 years. But past that point, it goes ballistic because it doesn't slow down there. It becomes unstoppable. And when you consider the hyperinflation that everybody knows about, like in Germany, gold went from 75 marks an ounce to 23 trillion marks an ounce in just a few years. That's what hyperinflation is.
Right. And some people say, well, the U.S. won't go into hyperinflation because people still want to buy our debt. And, the pound in Great Britain That one never went into hyperinflation. How do you answer those people, Nick?
Well, the fact is, even right now, the Fed is buying most of the debt. The Chinese and everybody else have stopped some time ago, and they've been net sellers recently.
And they've got their own problems in China and in Japan as well, right?
Right.
I mean, arguably, Japan's going to go into hyperinflation at some point, perhaps before the U.S.
Yeah, it'll probably be the first, and I'm not suggesting that the U.S. will be the first. It'll probably be the last. Like it'll be the last man standing. But nevertheless, you'll have the dominoes fall because it is worse in Europe, Japan, and the UK. Not to speak of most countries in South America. So those are problems that are going to manifest a lot earlier than in the U.S.
And even China, too. They've got their own debt problems, and their money supply is larger than the U.S. with a smaller economy, right?
Yeah, that's right. But you can't trust the statistics and numbers that come out of China.
Or from any government, for that matter, right? Is there any government's numbers who you trust, Nick, honestly?
That's right, yeah.
If they tell you it's dark outside, or that it's light, or that it's raining, or that it's snowing, are you not going to look up in the air and up in the sky and verify it with your own eyes?
Right, exactly.
I mean, let's face it. I mean, we live in an era of cynicism, and if you get one factoid from the government and you don't independently verify it, well, then, you deserve whatever you get at this point because, we're past the point of, lie to me once, shame on you, lie to me twice, shame on me. I mean, let's face it here. We're supposed to learn from our mistakes, right?
Exactly. But the thing is, it goes through generations. So the people that were around in the 70s, you've got to be 70 years old now to remember that. So the current generation has no clue, about what happened. All they know is the relatively booming 80s, 90s, and think that so far it was just a couple of glitches. Life goes on.
Hey, one thing you saw last week, all of a sudden they just halt trading on the NASDAQ. No explanation, nothing. Oh, there's a glitch. What's your take on something like that?
Well, we'll never know. There's a lot of theories that could have been hacking, could have been technical glitch, but those are the kind of things they never tell you the truth about. So
mighty suspicious, though, and it certainly is a chink or an further undermining of the system, right? You got to wonder.
Well, that's right, and this is where the crisis in Syria, so to speak, is probably instrumental in the gold price popping up, but it's kind of not necessarily any kind of a win-win situation, like what's going to be accomplished. And it could stir up a hornet's nest and create a lot of problems, particularly in the price of oil.
Oh, yeah, that's for sure. And, the price of oil was headed up before the potential clash in Syria. It's going to go up after, regardless what happens there, because we're dealing with fiat currencies, and that's one of the negatives, is that it's impossible to make predictions about future price trends because you don't know if that currency is going to collapse or if inflation will increase predictably into the future, right? It makes it impossible for normal businessmen like you and I to make sound, informed judgments about the future, right? Mises used to say that, and as well as Rothbard and Hayek and the rest of them.
Right. Well, what's interesting is that this correction looks very much like the 1974, 1975. Gold went from $35 an ounce to $200 by 1974. then it dropped to 100, like a 50% decline. And then from 76 to 1980, it went from 100 to 850. So if you take the same kind of math today, you get to $10,000 gold.
Yeah, and I think you're probably going to be conservative here. I agree with you. It's just too unpredictable, the world here, and who knows what we'll be valuing it at in several years, because who knows what the world's reserve currency will be, or what we will be calling currency at the time, because this experiment is not going to have a happy ending, and we don't have to go back too far in history to know this. Only got to go back 70, 80 years. We really don't have to go back too far.
And they never had a happy ending.
Yeah, it's not going to end well. You know it, and I know it. Unfortunately, your book, Gold 10,000, does not have a happy ending, and only for those who are holding some of their wealth in gold. The good thing, Nick, is you don't have to hold all of your wealth in gold and silver. Really, 10, 15%, right?
Well, that's the minimum. We had some studies done on that, and just to have a balanced, diversified portfolio, you need between, let's call it 7 and 16%, depending what the rest of the mix of the portfolio is. That's just for balance and diversification. And that's like a strategic allocation. For a tactical allocation that takes into consideration current economic conditions and inflation and so on and so forth, you have much higher numbers. So, for instance, Wainwright Associates, which does an institutional newsletter, they looked at how much gold you would need in a bond portfolio during a high inflation period, and they believe that we've entered the beginnings of a high inflation period. So for a bond portfolio, you need 18%, and for an equity portfolio, you need about 40%, and that's just to break even with inflation.
Well, something to think about for sure. So your book, again, we find that where?
Well, it's on Amazon.com, $10,000 an ounce gold. Getting more and more favorable reviews, so it looks like everybody's benefiting from what I had to say there, so that's encouraging.
Great. And your website, where do we find you?
It's bmgbullion.com.
All right, bmgbullion.com. And of course, Nick's been a frequent visitor and interviewee on financialsurvivalnetwork.com. You can find links to the site there as well. And once this interview's up, you get a direct link to his site, financialsurvivalnetwork.com. Nick, thanks so much for coming on. Always a pleasure. Be well.
My pleasure. Good talking to you, Kerry.
Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at Financial Survival Network.